the Indian stock market has been continuously falling. Why is it falling? What is the real reason behind it? This is going to be a very valuable video. Every morning at 9:15, there is hope that today the market might turn green, but by the time it is 3:30, your portfolio is red again. Stocks deep, and you feel like buying. The market dips further, and again you feel like buying. But this deep keeps getting deeper. You might be thinking this is just a normal market correction phase, but this is not a correction phase. This is an escape from destruction phase. That is why, over the last 2 months, foreign institutional investors, FIIs, have withdrawn nearly 1.55 lakh crore from the market. Now first, let us understand how big 1.5 lakh rupees crore actually is. With 1.4 lakh rupees crore, Assam can run its entire state for 1 year. Jharkhand can manage its annual expenses with 1.45 lakh rupees crore. Uttarakhand can do it with 1 lakh rupees crore. Even Delhi can run its entire year with 1 lakh rupees crore. Just imagine, money equal to the combined annual budgets of major states has moved out of the stock market in just 60 days. So what is really happening right now? Why are FIIs running away from the market? Today, I will quickly decode this for you in just 4 points. Point number 1. FIIs are not emotional investors. They do not care which government is in power, what is happening in elections, or what the market sentiment is. They care about only 2 things, price and value. At what price am I buying, and what value am I getting? That's it. Very simple. So first, India has become an overvalued market. How do we know that? By comparison. If you look at 2025 performance, the Indian stock market has been one of the worst performers globally. The Sensex has given only a 1.9% return, making it the worst performer among 17 major global indices. Now compare that with other countries. China has given a 14% return. Japan has delivered 22.5%. Brazil has given 38%. South Korea has delivered 53%. Investors follow one simple rule: buy low, sell high. When Indian market returns are low, prices are high, and the market looks overvalued, investors look at the pay ratio. India's pay ratio is around 22.6, which is considered expensive. China's pay is around 16, much cheaper. Brazil's pay is around 10.5, very cheap. In simple words, a big investor will immediately move to China or Brazil. India's pay of 22.5 is very expensive compared to China and Brazil, which are available at almost half the valuation. FIIs do not look only at growth, they look at growth at the right price. India is a growing market, but prices are currently too expensive. This is a temporary shift because the market is overvalued. But overvaluation alone is not the only reason. There is another major leakage where investor money is flowing out like water, and that is the Indian currency. This is my second point, the currency crisis. For FIIs, there are 2 risks. One is stock performance, whether the stock gives returns or not. The second is currency risk, what is happening to the rupee? Today, the Indian rupee has crossed 90 against the US dollar, which is the weakest level in history. $1 is now equal to around 90 rupees and 15 paise. Let me explain this with simple math. Suppose an investor earns a 5% return in India. But at the same time, the rupee depreciates by 5% against the dollar. The net profit becomes 0. This is called currency risk. So now the foreign investor is facing 2 risks, stock risk and currency risk. When the rupee weakens, profits automatically get compromised. To avoid this loss, FIIs are exiting. Now the question is, where is this money going? Point number 3. India is currently stuck in a sandwich situation between China and the US. On one side, US bonds are offering strong safety. US bonds are giving a yield of around 4.5% to 5% with very low risk. So foreign investors think, why take risk in India when I can sit comfortably in the US and earn 5% safely? On the other side is China. Even today, China is undervalued. That means stocks are available at very cheap prices. Sell expensive assets in India and buy cheap assets in China. Shift quickly. Now you might ask, if 1.5 lakh rupees crore has gone out of India, shouldn't the Nifty and Sensex have crashed by at least 20 to 30%? But that didn't happen. The market is still standing, with only mild corrections. There was no massive crash. Point number 4, the Abhimanyu of the market, the retail investor. If you closely observe the Indian market, you will see a clear contrast. On one side, FIIs are continuously pressing the sell button. On the other side, domestic institutional investors, DIs, are continuously pressing the buy button. Money coming through mutual funds, especially SIPs, keeps flowing in. Investors see the market falling and think, this is getting cheaper, buy now. Buy now. This SIP inflow of around 30,000 crore rupees per month has acted as India's shock absorber. That is why even after such massive outflows, the market has not crashed badly. In simple terms, FIIs are not breaking up with India, and they cannot. They have just gone on a short honeymoon elsewhere. FIIs are traders. They leave today and come back tomorrow when they see profits. This has happened before. In 2008, FIIs excited, but in 2009 they returned strongly. In 2013, during the taper tantrum, FIIs excited, but during the 2014 to 2017 bull run they came back. In 2020 during COVID, they excited again, but in 2021 the market hit all-time highs. Why? Because India's fundamentals are strong. India is one of the fastest growing large economies in the world. Its middle class has massive consumption power. Spending will continue, money circulation will continue, and consumption will remain strong. Global manufacturing is shifting from China to India. Apple has moved significant manufacturing to India. Samsung has one of its largest mobile production facilities here. India is emerging as a key hub in the global supply chain. Startups and digital public infrastructure are among the strongest in the world. India is also getting discounted oil from Russia, helping control inflation. And if you truly want to understand the stock market and master it, do one thing, invest time in yourself. Go to YouTube and search Complete Knowledge of the Stock Market by Dr. Vivek Bindra. It is an extremely valuable video with millions of views. Watch it, benefit from it. Also, subscribe to this YouTube channel and get all my videos in other Indian languages. Thank you.